it has broken enough stuff in the stock market to indicate that that asset category is now shifted to a negative long-term status, which is opposite to the major trends of gold and silver. They tend to be opposite. So if you look back and say, well, if the banks are going to crash again, wouldn't silver and gold crash? Well, go back and look at what happened in March through May of last year when the banks dropped 34%. Let's see, where are my numbers here? Gold was jumped to $250 in the same time period, and silver went up $7. So it was totally beneficial to them. So I tend to expect that same response this time around in the monetary metals once the banks are triggered. So it's something to watch, especially starting next week.
In today's news recap, silver price returns to the upside as recession fears allayed. Silver price snapped a 3-session losing streak on Thursday as it rose by 1.2% in the European session. Silver is finding stability as the market repositions itself for impending interest rate cuts by the Federal Reserve. Most analysts opine that the sharp declines witnessed across the board this week was mostly panic-driven correction with no data to confirm recession claims. Markets returned to the upside in the last 2 days after flashes of Black Monday triggered panic. The recovery has shifted attention to the Fed, with speculations of potential deep cuts of up to 100 basis points. This has restored confidence that a recession could be averted and could provide support for silver price in the coming days. The gray metals industrial demand outlook had recently taken a hit after disappointing economic data from China and the United States. The 2-hour chart below shows that silver price is currently on an upward momentum. Silver price will likely be on the upside trajectory if the action stays above the $27 pivot, as seen on the 30-minute chart. With the buyers in control, the pair will likely encounter the first resistance at $27.20. However, extended control could break past that barrier and send silver higher. On the other hand, a move below $27 will signal a shift of control to the sellers. Now we'll show you the best clips of the latest interview, but first, smash the subscribe button so you do not miss out precious metals recaps.
Or just sentiment in the stock market. Remember that's moved a lot by sentiment, not just so much data points, but I'm sure data points would be affected. I mean, if you're running a company and you have economic data points that are coming down, and you're not an economist, but you run your company, and you're either going to hire new workers or lay some off or not hire anymore or cut your production capability or not build a new factory, et cetera. All these variables outside that we're talking about, like, political uncertainty, data points that are getting worse, would cause you to have an economic consequence down the road if these things started to happen. So yeah, it could be. But I think the main thing is the emotional impact on voters who, when they're in the stock market, you don't want to have some dark cloud out there that is uncertain in terms of its wave effects. What do you want to do? Well, you want to stay speculatively long, or do you want to lighten up your portfolio and go to cash or go to bullion? And this is a variable, I think, that would assist the monetary metals again, because as you enter a period of uncertainty, this is also a factor that would impact the Fed decision. Oh no, they don't talk about politics. They swear that's true. Okay. But uncertainty caused by politics and its impact on economic data points, they'll be fully aware of that. And so if the Fed starts panicking because the bank sector starts to break in the next week or so, that's just the beginning. Sentiment can go from, light to dark overnight. And suddenly, if you have a fear factor, what are you going to buy? And I suggest to people that they stand back and, silver's weaker than gold now. Yeah. And we think that's caused by the stock market break recently. Well, we argue not. We think it's just the silver behaves like a wild dog. But look at the other variables out there that if they engage and you want a sense of certainty in your life, what do most people want to get into? Well, look at the portfolio action of like Newmont Mining. Stanley Druckenmiller back in mid-February probably laughed by other asset managers when it had bought a ton of Newmont Mining, and dumped a bunch of big name tech stocks. Well, it was a little early. The market didn't top out then. It was March, it was February, March. Market didn't peak till last month. So look, he probably missed something on the tech stocks. But he bought Newmont Mining around $32. Right now on a dip, it's at 47. How come it's doing so well? If the stock market's starting to wobble, how come Newmont's hanging around its recent high, which is dramatically off its February, March low? It's a blue chip, the big blue chip. How come gold's hanging around quietly, 1% off its all-time high weekly close? Somebody's buying it. So, and I think part of the reason for that is not just foreign governments we know are buying gold, but I think there's a rise in domestic consumption of that too, where there's a sense of uncertainty. And asset managers here are looking for something that isn't going down. And if you start to break the stock market more and more of them will start to look for something that isn't going down. Doesn't have to be going up, just look steady. And T-bonds are one of those that we called recently. Sharp upside there, drop in yields on the long dated end of that market. And the monetary metals, I think, are hanging in tough, except silver's the wild dog, of course. But I think that as these events start to unfold, that's where money's going to go. And so it's hard to calculate what that political variable is. But it's got to be, I think it'll be net positive for gold and net negative for certain other assets.
Where can
more toward investment grade timing. So we didn't suggest you buy silver at $30. You know, we suggested on the recent upsurge, if you weren't already long gold from much lower levels in silver, that when it came up through 25, annual momentum said, okay, if you're not in, you need to get in here. Not at 32 at the recent high. Okay. So yeah, it's well off that recent high, but it's still above that point of breakage. And gold is well above it. So we focus more not on short-term swing trades unless we think they're really significant and lasting. You know, they're going to generate some long-term move. We're focused more on the long term of the major markets right now, because I think right now what's going on is the resolution of an already ongoing monetary metal bull market. It is likely to be quite dramatic in terms of what happens to the upside in the acceleration phase of those markets.
Michael Oliver, a market analyst, warns that the Federal Reserve may soon be forced into an emergency interest rate cut due to mounting pressures in the banking sector. He draws parallels to previous economic downturns, notably in 2000 and 2007, when sudden rate cuts by the Fed signaled deeper problems within the financial system. Oliver suggests that the current situation may be nearing a similar tipping point, with the banking sector showing signs of significant vulnerability. One of the key indicators Oliver highlights is the KBE ETF, which tracks major banks. The ETF is displaying technical patterns that closely resemble those seen before previous collapses in the banking industry. According to Oliver, if this sector experiences another sharp decline, it could trigger widespread panic in the broader stock market. He believes the Federal Reserve would then be compelled to intervene with a rate cut, which, while necessary, might not bode well for market stability. In such a scenario, Oliver expects precious metals like gold and silver to benefit as investors seek safe havens. He points out that during the last major banking crisis in early 2023, gold and silver prices surged as banks struggled. Despite recent pullbacks in precious metals, Oliver argues that they are now poised to enter a new phase of growth, particularly if the stock market faces further declines driven by banking sector weaknesses. Adding to the uncertainty is the upcoming U.S. presidential election, which Oliver notes could exacerbate market volatility. He references a poll showing that many voters view supporters of the opposing party as threats, raising concerns about potential social unrest. This political uncertainty, coupled with economic instability, could further drive investors towards safer assets like gold, making the case for precious metals even stronger in the coming months. Now we'll show you more clips, but first, subscribe, and turn on notifications so you do not miss out our daily recaps. Enjoy the episode.
Economists out there who are mainstream pro-Fed type economists, who have said too high, too long. And even the Fed has stressed since early last month, even Powell gave a press conference where he stressed that staying too high too long could do damage, even without waiting for the data to prove that it did damage, that it could do damage. And yet he hasn't cut. What's he trying to do? Play a game? And a lot of people are wondering, why not? The job data has not looked good. And not only not looked good recently, but even when you look back at the prior job reports months ago, they were getting worse and worse in terms of, long-term jobs, not the short-term, et cetera. And they've ignored that. And now this Japanese event hit where Nikkei crashed. We have a yen crisis. The yen has rebounded, but it's caused a problem with the yen carry trade thing where a lot of people had positions based on, all that stuff. And a lot of that's unwound, no doubt, recently due to the recent sharp drop in the stock market and the panic. And I suspect this week we're going to hover around in the stock market and cool things off for a few days. Next week, probably resume. There is one variable out there that I know will kick the Fed in the gut, and that's the banks. We went through this back in January of 2023, the KBE, which is what we watch, the primary one, it's the ETF of the larger banks. January 2023 late, we warned there looked like a crash situation setting up for the banks. Technically speaking, we had no knowledge of any specific banks, And then the stories came out about regional banks and all that, but they did crash. And in fact, in early March, they hit our trigger number. And within about 5 or 6 weeks, they dropped 34%. Now, that's a crash dimension, that percent. It was a little slower than a crash, but still, it was a crash-like drop. The Fed didn't cut them because they were already in the process of raising rates, so they couldn't abruptly stop. But they've now said, okay, we're through raising rates, and they're looking for a reason to cut. And I'm telling you right now that momentum analysis of the KBE is almost precisely the way it looked prior to that March debacle, March, April, May of last year. The problem now is the market can't take it. The broad stock market. Back then, the stock market had already had a major decline in 2022 and was trying to turn up. So when the banks had that drop in March, April, May of last year, it caused the S&P to pull back a little bit. It didn't make a new low, but it was already had been punished. The S&P had. This time around, the S&P has only just now become vulnerable. And so if you kick the KBE through its structures, and they're literally a few percent below the low we saw this week, if you trade those levels, like we traded down to 47 on that ETF, you get down to 46 or much lower, and it's going to start. And I argue that if that starts, it looks like a something that could be fairly rapid, headline-y type stuff. That is a sector of the stock market the Fed will not dismiss. I don't think they care about NVIDIA, but they care about those banks. And if you look at what happened last week on a percentage basis to that ETF and also to the major name banks, the percentage drop they suffered last week and are not really recouping from this week was far more than the S&P suffered. And yet that wasn't a headline. You drop any more and we're going to trigger the banks. Now that's where I think the Fed will do an emergency rate cut. And that is not good for the stock market. If you go back to the 2000 top or the 2007 top, when the Fed started cutting rates, that was a sign they knew something was wrong. So I think we're at that cusp right now.
So you actually do see
the key is the bank index, the bank sector. And we think technically is very vulnerable to something dramatic. And I don't think it's going to be delayed too long. Why? Because the banks had a huge up month last month. And when you look at the price charts, it impressed a lot of people. Now, they didn't go back to their 2022 highs like the S&P and other indexes were, but they shot up, halfway back up there. They looked really good in July. They erased that entirely in the first days of August. The entire big, huge up month was gone. And so it's moving pretty quickly. And the structures we see were approached so closely. And when I say structures or momentum, I mean, if it were a price chart and you saw what we see on momentum, you'd say, oops, this is going to break down. Okay. We came to suddenly right to those levels. And you may pause for the rest of this week. That's fine. justification for that, technical justification. But it looks like it was intent to come down and break those structures. And if you do, I think you'll see precipitous further price decline in the banks. This time, one that the Fed will respond to, unlike back in March of last year. And I think they'll have an argument to do so, and it won't be, something going on in Japan and the Japanese carry trade and all that stuff. This will be domestic. So it's something to watch. Now, by the way, I'm going to mention this because the silver and gold investors are rattled right now, especially silver investors. We'll get on that in a minute. But basically, it's our argument that the monetary metals are in opposite sync now to the stock market. Yes, recently they pulled back, but they've already been pulling back basically in momentum terms since April, May. So it's been several months of congestion for gold and silver and pullback in silver. Meanwhile, stock market only peaked last month. While they were pulling back and pausing, stock market made its high in July. I can express an opinion on either side, okay? But my assessment is this: that is a factor that is not in the markets. Everybody knows that the country is divided, et cetera, and it's maybe different this time, but nobody senses that there's no outcome to this election, no matter which side wins, that's going to be copacetic. In other words, it's going to be uncopacetic. Now, I'm going to give you a hint. Now, this is not me talking. This is University of Virginia. I may have read these before on one of your interviews, but I want to do it again. Back in October of last year, they had a poll at the University of Virginia Center for Politics. They polled both Biden Democrats and Republicans, likely Trump supporters. They asked some very interesting questions. And here's one of them, and I'm quoting them directly. Roughly half, 52% of Biden voters and 47% of Trump voters, again, this is like 9-10 months ago, viewed that those who supported the other party were threats to the American way of life. Huge percent. About 40% of both groups, 41% of the Biden, 38% of the Trump voters, at least somewhat believe that the other side had become so extreme that it is acceptable to use violence to prevent them from achieving their goals. Okay, now if you think things have cooled down since then, we know that isn't true. And I suspect, therefore, if the University of Virginia did this poll again, they'd find the numbers are even higher. Propensity toward acceptability of violence. Well, again, is this priced into the stock market's view of future reality? Are we about to see 54 card pickup? The tablecloth yanked off the table, everything shattered. And we don't quite know what's on the other side, but it isn't orderly. Is that priced into the market? I don't think so. It's just something to ponder on. Again, that's the numbers from University of Virginia Department of Politics poll.
What do you think of Michael Oliver's take? Do you agree with him? Is he spot on? Post in the comments section down below if you think gold and silver prices will go up in a recession, or if, on the contrary, metals prices will go down like everything else. Subscribe if you have not yet done so, and check this video right here because it's a perfect fit for you. I'll see you on the other side.